It's also coming through with really flat and unchanged kind of rates. Let's look at the Nifty heat map before we go any further. Take a quick look and then we will sort of get down to it in terms of individual movers. What do we have as far as the first kind of picture is concerned? How many up and down? 840 up on the NSE and about 650 down, but that's very, very initial early rates. It is, what, 30 or 32 names lower and the rest which are higher at this point. So Wipro right on the top of the list. There's good news there. And the other end is Apollo Hospitals. But I don't think there's anything large, right, in terms of single stocks in the Nifty 50 which are making a move. Surbhi.
No, there isn't. It's very quiet start. Apollo Hospitals is down about 0.5% as we're looking out for that block trade where the promoters sell a little over 1% equity. That's the anticipation. Let's look at, it's still down about. It's the biggest loser on the Nifty right now. ICICI Bank, SBI Life, HDFC Life, some of the financials are undoing their yesterday's up move, especially the life insurance companies. There's also Reliance, which is a little sluggish this morning. TCS is down about 0.3%. HDFC Bank is down 0.25%. So this is pretty much where the drag is coming in. ICICI Bank is now down almost 1%. So financials are weak. Apollo Hospitals are about 0.5% lower. On the flip side, Wipro, with that acquisition, that's definitely catching the market's attention. 1% higher on Wipro. Apart from that, there's Tata Motors, a little bit of gain. BEL, 0.5% higher. Mahindra & Mahindra, 0.5%. That's it. It's a very quiet Friday morning. Nigel.
Well, that's right. But a few stocks in the broader markets are moving around. Lemon Tree, I recall the stock yesterday had a good trading session. In fact, for this week, Lemon Tree is up close to around 18%. That's one of the big movers. It's up close to around 3.5%. I think we had a guest, not able to recall the name, who had said that Lemon Tree could be an outperformer, actually. And that one, in fact, this week itself. Deepan Mehta, yeah. Deepan had spoken about this name. And that one clearly is firing all cylinders. Tex Macro Rail, that's the other one that's up close to around 4%. So big move is what we're seeing out there. In top volume movers, DCX Systems. That stock is bursting away. It's up close to around 8.5%. Massive volumes on that name as well. Vodafone Idea is holding up with a gain of close to around 2%. So we should get that one as well up for you on the screen. Indus Stars, it's been a rank underperformer. But if you're going to have three players that will survive, then it could be more business for Indus Stars. And that's why that stock, in fact, is up and about in today's trading session as well, up 1.5%. Otherwise, Coffee Day, I think the stock this week is up more than 20%. It's now coming for some profit taking on the downside. Swiggy, not swigging it away today. That one as well is down close to around 2.5% after seeing a good rally in the last week or so. IDBI Bank as well, some profit taking. And BSE. The problem is that there could be an earnings hit. The magnitude we'll have to see, if you're going to have reduced expiries. So that's why that's down another 1.5%. And MCX, well, that's an optional value out there. So no direct earnings hit as such. The problem will be on the valuation front. But clearly the stock that's catching your attention is DCX, up 12.5% on that name.
No, absolutely. And stuff coming through right now on some of these names. 50 points lower on the Nifty, 25,030 is where the Nifty is at this stage. Just a few other names, right? Lemon Tree is there, up there. Divi's, of course, I just mentioned right before market opening, that call from Citi, 2% higher on Divi's. There's a company called ISMO. It's, they've essentially... They've got a semiconductor, I think, packaging business. I think it's an OSAT business. But look at the volumes. It's the fourth largest volume-led gainer on the NSE, out of the blue. And they've developed a new way of packaging these chips. So we'll have to see exactly. We'll have to get into it. But it caught my eye. So just making a mention of it. We'll have more on this one, maybe with Hormuz a little later. Indus Tower is coming up. Is not seen that amongst the top volume-led gainers list, 1.5% on Indus Tower right now. PG Electroplast has been constantly, down a lot earlier and then up a fair bit this week from the lows. 480 or so was the low, and it's picked up about 100 rupees from there over the last 5-6 days. SML is Isuzu was the other one, big mover yesterday, and what a week it's actually. More than a week, what a month it's had, right? 40% on SML so far in the month of August. Sagility, I think Kotak has initiated coverage on Sagility. So we'll maybe ask Sanjeev on that. Yeah, I mean, all-time plastics is another name. 3.5%. There was a deal earlier from one of the prominent investors. So that's seeing some gains coming through. Nazara is another one on the downside. Nazara is down 3.5%. It was down sharply yesterday. Actually, it started slow in terms of a correction. We had the management with us, but by the end of it, it was down almost 10% and is down a little bit more, 3.5 lower right now. So on the downside, apart from that, with volumes, there's very little to talk about. Things will pick up. Nifty is down a full 80 odd points now, 25,000. Sanjeev Prasad is our market master of the day. He's with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good to have you with us here. Thanks for your time. Some are making the case that maybe consumption has been in the doldrums, and these GST-related reform simplifications, if it is done in a meaningful way, can turn the tide. And within people, and if you look at the basket of people with that view, some say it could be a tactical move, some say it could be a really, durable one. First of all, do you believe it is possible? And how do you think about it? And where will this show up in a big way if this were to be a meaningful reform?
If you look at what the government has been trying to do in the last 6-7 months, clearly the effort seems to be on reviving consumption demand. I think the government realizes that investment demand has been on the weakest side. And starting with the income tax cut, which was announced in the budget, you had then the RBI cutting policy rates by 100 basis points. And now you have a more action in the form of GST rate rationalization. So hopefully all these things result, some pickup in consumption demand. The bottom of the pyramid consumption has been really struggling given income challenges over there, and the fact that affordability has been a big issue. Prices have gone up a lot across the board. The whole idea is, to make things more affordable, and hopefully, companies pass on the full benefits of GST cuts to the consumer, which results in prices becoming or items becoming more affordable, and hopefully demand picking up. So that's what the government is betting on. The market has a slightly different take on this. The market seems to be assuming that most of the cuts in the GST rates, whether it is 28% items moving to 18% or 12% items moving to 5%, most of them will retained by the companies, which will result in a big increase in the profitability and profits, which of course means that you may not have that much of volume impact. So let's see, how this exactly plays out with a combination of profitability versus volumes. The common intent is very clear. It wants, the cuts to be passed on and result in high profitability and volume growth. Market seems to be taking a different view on that, so let's see.
That would be a bit of maybe a self-goal, won't it, Sanjeev? Hi, morning. Great to have you on, because we've seen that in the past as well, right? The benefits of lower commodity costs over the last, and I'm not talking Q1, but in general, we've had patches of reasonably decent, margin sustenance. The problem for the market, however, is growth. And on that, where do you think we stand at the end of Q1? Do you feel we'll at least get into double-digit earnings and maybe better-looking top lines by the time we get into full-blown festive season?
The growth challenges remain. It's been sluggish, and that is why the government is trying various things to revive consumption. Do keep in mind the fact that some of the drivers of GDP growth in the last 4 or 5 years, which was largely high-income household consumption and government spending and household spending, that is residential real estate. All these 3 items look like they could see some slowdown. I mean, government capex, we anyway know, the government budget numbers for FY2026, that's the central government number, that's only a 7% growth. So clearly that's a big slowdown compared to the growth rates which we have seen in the last 3-4 years, particularly FY2020 to FY2024, where you had massive growth in railways and road spending, etc. Given the challenges of weakish sentiment in the IT sector and also especially spreading to the GCCs, and given the fact that residential real estate prices have moved up a lot in the last 18-24 months, I would expect household investment, that is purchase of residential real estate, that should also slow down. Hope is, somebody will see some revival in consumption, which balances out the slowdown in investment. Exports is anyway, a big challenge as of now, given what was happening on the geopolitical front, as also on the whole trade tariff issue. So with that background, I don't know. It doesn't look like you will see a big acceleration in the economy. The hope is somewhere in the festival season things start picking up, but let's see.
So numerically, Sanjeev, so I didn't quite get the range. So numerically, now that Q1 is over, where are you with respect to full year earnings estimates?
So we are about 9% now, 9.5% to be precise. But the quality of earnings growth in FY 2026 is not great. I'm talking about Nifty 50 index. More than 60% of the incremental profits are actually coming from three sectors, and which really don't have much to do with the economy also, to be honest with you. So if you look at about 20% is coming from the metal mining sector. That is largely on the back of improved profitability for the steel sector, on the back of safeguard duties. Then you have the telecom sector, including Reliance, which is going to contribute to incremental profits based on the expected increase in tariffs somewhere in December, January timeframe, and the fact that you're seeing the full benefits of the tariff increase last year, that's playing out now. And lastly, you have ONGC also, which is contributing about 20% of the incremental profits. That's more to do with the gas price formula. So the nature of the incremental earning growth is not a very good quality. It's not as if we are seeing some big recovery in the economy, which is resulting in this 10% earning growth. Hopefully that will play out in 2027, but that remains to be seen. As of now, the growth trajectory for the broader economy itself is looking a bit challenged, I would say.
As you said, 9% Nifty earnings growth for FY26, right? That's your estimate.
Yeah.
Okay, got that.
Hi, Sanjeev. Good morning. Good to see you, Ben. Sanjeev, what according to you is the message that the government is sending out? In the budget as well, the focus is on putting money into the hands of taxpayers, more money. Even now with the GST cuts as well, they're indicating they're focusing more on the consumption story. While the capex expenditure, that seems to have taken a bit of been put on the back burner. No big increase this year. You have big elections as well coming up. What is your view on this? This is the government that actually was, ramping up on the capex side. Now that seems to be turning a little bit. Your take?
Yeah, I think the government realizes that it can do only that much with respect to investment. Particularly if you look at the central government, there are three areas where the central government can spend dramatically. One is defense, second is railway and roads. The challenge over there is if you look at railways in particular, your expenditure used to be about 680 billion rupees or so in FY 2020. That has already gone up to about 2.5 to 2.6 trillion rupees by the time we hit FY 2025. A lot of low-hanging fruit on the railway cap is already done in my view. And what I mean by that is electrification, which used to be, sub 50% about 10 years back, that has now crossed 90%. You have put in a lot of safety signaling systems and so on and so forth. On the back of that, your average railway freight and passenger rate movement, that has gone up. On the back of that, India has already ordered a lot of rolling stock, coaches, buses, etc. So I think as you're hitting some sort of a peak with respect to the capacity utilization of the current railway network, which means you will not probably see a big increase in capex on railways. If you look at roads, where you are seeing a similar growth, of similar 680 billion rupees in FY 2020, went up to about 2.4, 2.5 trillion rupees by the time we hit FY 2024. I mean, India has already a very decent, highway network, right? Intercity network is actually quite good. So you will see a natural slowdown over there. And I think the government understands that it can only do that much. Where India needs to put in more money on the capex side is the intra-city infrastructure, a combination of, urban housing, mobility, and water. Of course, the states are constrained, given the fiscal challenges, etc. And institutional capacity is also a bit weak over there. So I don't know, it looks doubtful that government capex is going to accelerate. Just to give you some data, if you look at public sector plus government spending as a percent GDP, that used to be about 6.9% of budget in of GDP in FY 2020. That went to about 7.9% by the time we reached FY 2024, which means it was going much faster than normal GDP growth. But that's about it. I think we are flattening out over there, which means the government has to try something new, which is basically the extra focus on consumption for now. In the meantime, we are still waiting for private capex to pick up. That's been sluggish. It's been in the range of 11% of GDP for the last several years now, and no signs of acceleration over there. So I guess the government is trying whatever it can. It knows that its own spending on capex is going to be limited going forward. Private capex not yet picking up. So let's try whatever we can do on the consumption side.
Got that. You got a call on Sagility, Sanjeev, this morning, I believe, right? Do you want to just take us through that? Just the thesis?
No, it's initiation of 3 companies in the BPO space, actually. So it's got nothing to do specifically with Sagility. So we have 3 company initiations: Sagility with the buy, Source with the reduce, and Eclipse with the reduce.
Yeah, but out of the 3, there's only Sagility which is a buy. Hence, I was asking about that. Target of about 56 or so. You mentioned a few names, Sanjeev, but out of the coverage universe, as you look ahead, right? When clients ask you for ideas, what do you tell them in terms of single stocks? Really top of the list, absolute return candidates from here.
A few banks, the Tier 1 private banks, a couple of Tier 2 private banks, some of the domestic pharmaceutical companies and healthcare services companies, which are hospitals and diagnostics. A couple of names in capital goods, but that's about it. That's been our model portfolio anyway for the last 12 months or so. Nothing has changed over there. We continue to be pretty negative on consumption from IT services, given the combination of very stiff valuations and not much of growth for now. So nothing has changed really in terms of our view when it comes to the market or to stocks.
So on consumption, just to wrap it up, Sanjeev, why is it that you're not at all optimistic of any sort of a revival on any element of consumption? I mean, whether it is premium, mid, lower end, because of what you started off by saying, that companies will probably pocket the benefits of this GST cut. Is that why?
Well, I'm not saying I'm not positive on consumption. I'm cautious on consumption. The hope is it will recover gradually from where we are, but it's not going to be a massive recovery. Keep in mind the fact that India is simply not getting enough number of good quality jobs, and we have written enough on that. You look at the government's own PLFS data, most of the incremental workforce is ending up in agriculture or in the gig economy, where of course income is not going to be very high. So that fundamental structural problem still remains, and for that we need private sector investment to really pick up, for jobs to be created on the back of that, incomes to grow and consumption to really take off. I mean, we are nowhere near that cycle to start. The bigger problem with consumption is not so much whether it will recover or not recover, it's just the valuations. Even assuming if you see a big recovery, there's no way I can justify 45 to 55 P, which is where most of the consumer stable companies are trading at, with the kind of growth rates they're reporting, or even with some acceleration in growth rates. Even if they go to, let's say, mid-single digit, high single digit, I mean, there's no way you can justify 45, 50.
I think, Sanjeev, the market is hearing you very closely. And the market's now giving up some of its excitement of earlier in the week, because as we are speaking, the morning is looking a bit red, 128 points lower on the Nifty. But yeah, we take your concern on board. And I think we have to see how the next couple of weeks and months play out, and if indeed that consumption boost comes through or not. Thank you so much for joining us this morning. Thanks very much. Great conversation. Let's just pull up the Nifty now, 24,950, so 25,000 for the time being. Bulls are finding it hard to hold on to it. Maybe just want to kind of keep some of those gains back in the pocket, considering it's been a good week so far. Right now, it's a downward slope. Mid-cap index is relatively better off. Bank Nifty is also down about 0.6% at this point in time. So a bit of a slippery slide. Let's focus on a couple of individual stocks then. We've got Sud joining in. He's, I think, looking at Divi's and Mazgaon Dock. So tell us more. Oh, we've got Vinny in as well. The more the merrier. Go on, Sud, let's start with you.
So first on Divi's Lab, Citi has a buy call and target that it has given is of 7,750 per share. It believes the recent weakness in the stock is a buying opportunity, because also valuations are reasonable due to sector tailwinds and the pipeline that company has. Also, it says that concerns around orforglipron, that is weight loss drug, appear overdone, and by FY30 total sales are likely to be more than $15 billion plus. That's the even estimated sales are there, and strong adoption in tirzepatide Tirzepatide is basically obesity or diabetes drug, and upgrades in product indicate an increase in peptide GLP-1 TAM. Also, concerns around Entresto going generic in the US may start fading away. That is Citi believes. Second is Mazagon Dock. That is JP Morgan has written a note, underweight call, target is 2468. So from current levels, JP Morgan believes that there is a possibility of 10% downside in the stock. It says risk reward remains adverse despite stock price correction because Q4 FY25 and Q1 FY26 results are weak due to provisioning related to cost overruns. Also, large order award for P-75 Scorpion submarines have been delayed, and it believes that it might be delayed further, and that will have an impact in the earnings going forward, and that's the reason it has an underweight call.
Okay.
Absolutely. Sud, thank you very much for that. So those are the two calls, Mazgaon and Divi's, which are in focus. Well, our systems is what we want to talk about next, and stocks flying away. Vinny's got details here. Vinny.
Hi, so the stock is buzzing in trade today because they've acquired one of these companies that is called Novigo Solutions. This is for 400 crores is a cash consideration. Plus, there will be stocks that are linked to achieving some EBITDA performance. So on the back of that, there'll be additional amount that comes in as well. Now, obviously, let's talk about this acquisition. Why is it important? Because with this, our systems will be expanding its offerings, especially coming in the Middle East region, which has been growing very fast, and plus gaining the delivery presence in Bangalore and tier 2 cities in India as well. This acquisition is expected to be EPS accretive from the first year itself. Novigo financials, when you look at it, revenue is at around 264 crores in FY25, EBITDA is at 25%, and obviously they've been seeing a strong growth in the last couple of years as well, 44% CAGR growth over the last 3 years. Do not forget, our systems in Q1 or June quarter, when you look at it, that time their EBITDA margins were at 17.3%. So this acquisition in terms of margins is accretive, and like they've said as well, from the first year itself they'll be doing well. And for our systems, in terms of their past story and history of acquisitions as well, in the last couple of years they've managed to do well in terms of big acquisitions and turn around these acquisitions and gain because of these acquisitions as well. So that is why a positive coming in here for our systems.
Acquisitions and acquisitions. I was just thinking of yesterday, we were talking about Aurobindo, markets' concerns about them acquiring a huge, giant-sized company. Of course, there's not a straight comparison at all. But in this case, an acquisition has worked very well for our systems. Thank you so much for that, Vinny. Good to get that perspective. Stocks doing very well on an otherwise dull morning. Okay, it's time to get to our first corporate conversation on the show. And the company we're looking at is Hudco. Now, Hudco reported pretty strong loan growth in the first quarter. The company's urban infra segment did fairly well. There was some pressure on margins, however. So we're going to be discussing all of this and more with Mr. Sanjay Kulshrestha, Chairman and Managing Director of Hudco. Sir, great to have you back with us. You know, we're going to be focusing on 3 points, and I just want to lay them out for our viewers. So let's quickly get to it. First of all, we have to understand if Mr. Kulshrestha wants to increase his guidance, because in terms of AUM growth, the company has been doing phenomenally well. Then we'll talk about the margin pressure and what happens, whether it gets better from here on. And finally, we'll talk about the ROA expectations from Hudco that shareholders can perhaps have. Mr. Kulshrestha, great to have you on. So let's start with the good first. And that is the way your AUM is growing, right? I remember when we spoke earlier, a couple of weeks back, you had said that you will be crossing, I think, 1.35 lakh crores. Yeah, that's what you said, that you will be probably doing that in the third quarter. But since you've started the year on such a strong note, aren't you planning to revise that guidance? By the end of FY26, where will your loan book be?
Definitely, I think you are right. We need to redefine our targets, and we are working on that. Hudco is a very sector-agnostic company wherein we can fund starting from the basic infrastructure of water, drains, or energy or waste management. And on the onward side, if you see, we can fund port, airport, new towns, and there are lot of infrastructure which is planned by the state governments. So this is definitely giving a good tailwind to the Hudco, and this is the result of that thing only. So we will be revisiting our guidance because I know that with this kind of pace and with this kind of opportunity, it is required that we should revive our 1.5 lakh crores by 26 guidance. And I think we will be completing this target in Q3 only.
So, sir, by when will you have a new guidance? And even if you can't share an exact number with us, I mean, ballpark, will you have 15% loan book growth this year? Could it be better than that? And by when will you have a new number? 1.5 going to whatever it is, 1.7, 1.8 lakh crores?
We are planning to come out with the number in Q3 because things will be more clearer by then, because finally these sanctions has to be converted into disbursement. You may have seen that our sanction has grown from FY 23 25,000 to last year it was around 1.27 lakh crores. So these sanctions, since these are very capital intensive projects and with a construction period of 3 to 4 years time, so we are still taking the inputs from the sites and the fields. And definitely we will be reviving this number in Q3.
Okay. All right, Mr. Kulshrestha, so that's on the top line front, and that's not a concern at all. Now let's talk about margins, because margins, I mean, your guidance has been that margins will be well over 3% this year, but there was pressure in the first quarter. Is that a short-term sort of phenomena? Just tell us how your cost of funds is moving, and what you can expect on the yield side as well. Which are some of the more margin accretive projects that you're planning to lend to this year?
I think you are right. It was a temporary phenomena of quarter one. Most of our disbursement has gone on a last part of the quarter one. That's why this ROA or the margins are looking at a squeeze. But definitely this will be a lot of improvement will come in quarter two and quarter three, and we will be stabilizing by quarter two. All these assets which we had funded, all this disbursement will be converted into the bottom line. So definitely these numbers will increase and improve. So I have no doubt about that. Yeah.
Okay. All right. Hi, Mr. Kulshrestha. Good to see you. So good morning. Couple of quick questions then. There's a DAM Capital note. They've initiated coverage on the stock. They have a buy rating, target price of 280. They are citing valuations. They're saying you're trading at 10 times, some of your peers are at mid-teens. That said, I just want to clear out a couple of points because they're positive biases because of a couple of aspects. They're talking about 50,000 crores of disbursements in this year, which will ensure 30% loan growth in FY26. Possible, right?
Possible, yes, definitely.
Okay, all right. And for the next few years, 25% AUM growth is doable?
It's doable because if you see the opportunities and the wide aspects of the company which is funding, and if you see, a lot of states has came out with their own investment policy by 2030. The CRISIL intelligence report has revised the targets, and now, which was around 59 lakh crores during FY19 to 24. Now they had revised to 1.6. So definitely there are a lot of opportunities and there will be upside. So 25% of the growth is catchable to support the sectors.
Okay. So you're saying 25% growth of the loan book is possible, and that's a big number. And I think shareholders will like that clarity. Just to go back to the margin point, sir, while you said margins will improve, do you retain that guidance? I think you're talking about almost 3.2 to even maybe 3.3% by the time this year ends. Are you still?
Yeah, we are definitely on that number. It will be between 3.2 to 3.3. So we are working on that. And if you see, during quarter one, we had raised around 20,000 crores and our average cost was only 6.32. And with this S&P upgrading our markets, our sovereign rating, I am definitely sure that it will transfer into the external commercial borrowing rate reductions. And we are expecting some good news from the RBI. And with the CRR change also, we are expecting that the markets will reduce some rates from the banker side because of the higher liquidity. So definitely we are working on these kind of margins only. So I have no doubt that we will retain these kind of guidelines like NIM around 3.2 and the spread of between 2 to 2.2.
Okay, all right. Sir, I wanted to ask you about your return ratios. The ROA is around 2%. You have been guiding that it goes back up to around 2.2%. So tell us what are the levels you have in store. And just referring to the note that I was looking at, they are working with ROEs of around 15 to around 17%. That as well as doable?
Yeah, it's doable. If you see ROA, we will be from last 2 years, we are maintaining around more than 2.2%. So now we will be consolidating at around 2.2%. And I think this quarter one will be the exception, and because of the disbursement and the last minute disbursement. And if you see, our loan book is continuously increasing, and this loan book is actually The increase in the loan book is reducing our ROA. But we are prioritizing increase in the loan book over ROA because finally we will get the ROA in quarters to come. But the increase in the loan book is our primary and the priority kind of thing.
By the way, we've got confirmation on that Apollo trade. This is the promoter group that has sold down a small part of their equity. It's about 1.3% stake sale that's happened, and now the promoter shareholding in Apollo Hospitals is 28%. And the sale proceeds are going to be utilized to pare down the debt of the promoter group, which also means that there's going to be a significant reduction in pledges on promoter shares. So that's the explanation, and you're seeing that play out on the stock. And as was, perhaps you can say, it was kind of expected as well. The dip has gotten bought into, and the promoters have already given the clarification as well as to why they have chosen to sell this small bit of equity. Apollo Hospitals in news today. Mr. Kulsheshwar, before we let you go and before we wind up the conversation today, sir, a slightly more medium-term picture. And we know that the pivot is happening. HUDCO is now a large urban financier. And you've stated in the past that you want almost 75% of your loan book to be coming in from the urban infra space. By when will this pivot be complete? What's the breakup of your loan book right now? And say 2 years down the line, what would the mix be? And as you keep moving towards urban infra, what happens to the margin profile? Should we expect it to improve? I mean, I'm not just talking about this year's 3.3%. But as your strategic shift is completed, how will the margins look?
Post accreditation by the RBI to become a IFC, we had changed a lot of things. We had changed the paradigm that HUDCO is no more a housing finance company, and now we are working towards the entire gamut of the infrastructure. So in housing, earlier you may be knowing that we were only doing the PMAY counterpart funding to the state government, which is required, and which was going at a very lower rates with very competitive rates to support that sector of the affordable housing to the states. So now, since we are diversifying towards the infrastructure, definitely our margins will improve from the infrastructure returns. So that is point number one. Regarding the housing portfolio, if you see, the PMAY 2.0 has already been launched, and around the 7 to 8 lakh households are approved by the ministry, our ministry, and another demand of 50 lakh houses is already with them. So in case the states comes to us with any counterpart funding, which we are looking at maybe in Q3 to Q4, such kind of demands will increase. Then only it will be sanctioned. But in years to come, I think definitely most of our share will go towards the infrastructure. Presently, we are at around 68%, and by FY26 completion, we are planning that we should achieve this 75% of the mark.
Okay, so 75% of the book is going to be on the infrastructure side. The residual would be on housing. Got that point. Thank you very much, sir. Good conversation. Thanks for joining in today. Well, we do have to take a very quick break. Come back on the other side, and we will have the management of Healthcare Global joining in to talk about the outlook for the current year, as well as to understand why private hospitals are opposing General Insurance Council's common impanelment, citing pricing and claim issues.
Welcome back. Some signs of bottom fishing actually on the Nifty. We're pulled back a little bit from the day's low. So that 24,900 mark is the important mark. For the time being, some kind of pullback. The good news, though, is that the number of stocks advancing have moved up and the mid-cap index has moved into the green. Let's revisit a couple of stocks that are moving around. Wipro is the one that did some inorganic growth. Rima joins us to run us through the fine print. Rima?
Thanks so much for that. So Wipro has gone ahead and announced the acquisition of DTS, Digital Transformation Solutions, which is a business unit of Harman, which is a Samsung entity. They're paying $375 million. Well, why is the stock down? Because otherwise it's very complementary. It expands their focus in ER&D. It shows aggression. This is the first acquisition done under the new CEO, Srinivas Pallia. Well, a couple of reasons. One, the entire IT pack is weak in trade after the rally that we had earlier this week. Secondly, the acquired company has had flat revenues over the last 3 years. In calendar year 22 and calendar year 2024, the revenues of the acquired company was flat at $315 million. Secondly, because of the larger on-site presence and the business nature, the acquired company has lower margins. In fact, a Nomura note says that this acquisition could impact Wipro's EBITDA margins by 50 basis points once it's fully integrated, which is in FY27. And HSBC also points out that the valuation gap of Wipro versus peers is now at a historic low. So these could be some of the reasons why you are seeing the stock subdued.
All right. Rima, thank you very much for that. Okay, I think...
All right. Okay, let's...
Okay, I think I have the mic back. Let me just put this on. Thanks, Nigel. Well, I think we have the management of Healthcare Global, which is in focus. And we have Mr. B.S. Ajay Kumar, Executive Chairman at Healthcare Global Enterprises, joining us now. Mr. Ajay Kumar, good morning. Great to have you with us here on the program, sir. It's always good to see you. I want to, for our viewers, put out three things that we want to sort of obviously discuss, apart from other things. One, of course, is this entire issue of private hospitals opposing General Insurance Council's common empanelment, citing pricing claim issues. Second, outlook for FY26, of course, and beyond that. And of course, number three is the company's strategy, on growing the oncology care, especially now with KKR as a partner with you, buying out CVC. So we'll talk about all this. Mr. Ajay Kumar, as I said, great to have you with us here. Stock's done very well, sir.
Yes.
When this KKR transaction happened from 500, gone up 30-35%. And of course, I mean, that's a smaller move. The bigger move has happened, and it's basically doubled from 2000 and, over the last 2.5-3 years or so. And many investors believe there is more to go. You are perhaps the only large pure play oncology care health provider, hospital company. So give us a sense, Mr. Ajay Kumar, of what are the since February, since this transaction took place and you got a new partner. What are they driving at? Give us a sense of what's happening. What is the guidance you want to put out? One common thing I hear from many is that margins will continue to improve, and you're still below where other players are, and that gap will close. So just give us some quantitative idea about how the thinking is evolving, sir.
I think, first of all, we are very happy to have KKR, who has significant experience in healthcare. And coming from a perspective of that, and also our operational excellence is really improving significantly now. And with that happening, we are looking at, as you said, improvement in the margin. And as you said, the outlook is very good because our growth is about close to 15%. We'll sustain that. And also, what we are looking at is niche areas where we think we can create the hub and spoke model. With this, like infusion centers, which we have spoken before, all of this will give us an upside as we move forward, being a single specialty. And one of the things I want to add is, when people want the first time right care in oncology, they are moving towards a single specialty because we have published outcomes which show very good, equal to global standards. And this is what we look at when we look at a cancer patient. What is the first time right treatment and what will be the outlook for the patient going through the treatment? And globally, cancer actually has shown a great improvement. And what I'm very proud to say today is we are on par with the global best centers. Like I studied in MD Anderson, we are on par with that. in terms of outcome when you look at breast cancer, GI cancers, head and neck cancers, where we are very focused in research and academics. And this is what is giving us that destination. So we are truly become a destination for oncology in India and this part of the world, including Africa. And that is what is driving us.
Yeah. No, and that's the other thing I hear from investors, that acknowledgement that, there's a fair bit of R&D work, etc., with cancers that HCG and you've sort of been able to do, and you're passionate about that. Just give us that margin trajectory, sir. I was reading another note which said that about 40% of the beds are still in ramp-up phase. Could you leave us with some numbers? Where do you see margins? When will these beds become margin accretive? Overall, at a HCG level, what is the margin trajectory going to look like? What kind of improvement should we expect every year?
Like I have always said, our first target in margin is to achieve 20% and above. And I think we are on the way to achieving that, hopefully in the last quarter of this year. And we have taken really a lot of steps, particularly with a new CEO coming, Mr. Dr. Manish Mathur. I think we are all well aligned to see this improvement happens overall, particularly our centers, which were initially lagging behind, are showing a significant improvement now. And this will sustain. With this, I think our margin will reach about 20%.
And it will, you'll stay there after 20 last quarter this year, and then 20 is, you will maintain at least 20.
Yeah, that is our goal, and our internal strategy shows that we will achieve 20%.
Okay, and it will, beyond that, I mean, any thoughts?
Yeah. But if you look at our center of excellence, Bangalore, the margin is over 28 to 30%. Similarly, in a center of excellence in Ahmedabad, these are the things which we are out to achieve. Can we achieve the same goal in other centers? So for example, Cuttack has a good margin. So our goal is to see whether all of the centers can scale up to this center in Bangalore. And this is where we are headed, and we are in the right path to achieve that.
Okay, all right. Hi, Dr. Ajay Kumar. Good to see you in, sir. Commentary with regard to cancer as well, and the fight against cancer. More power to you, your entire team as well. Gives a lot of hope out there. But that said, KKR announced the acquisition of HCG in February 2025. Now, CVC, they still hold close to a 9% stake. Have they communicated what they want to do with that 9%? Is there a timeline by when they, sell that? Point number one. Point number two, you have taken some money off the table. There was a small, large trade that we saw earlier this week where you sold some stake and a renowned mutual fund bought that stake. As of last count, you had 10.8% stake in the company. Will you look to further bring it down?
No, I have no idea. I do not think so. The only reason I did that is because, where I am in the schema of things, I want to use some of the funds for my philanthropic activities, which have been a long dream for me. So I am using that for women development, leadership training, rural areas, healthcare, education, and policy in terms of disparity. So this is where I started a policy institute. I'm going to use most of the funds to develop those institutes. As far as the CVC is concerned, I think agreement is that they will come down to 6.6 with 3% more going into KKR. That is the agreement after the open offer. We are waiting for the final numbers. Once that happens, we'll get more clarity on that. So this is where we stand. CVC will be around 6.5-7%. I will be around 9.88%. And of course, KKR will be around 54%. The rest will be the publicly held at this point. And I have no intention of doing any further dilution at this point.
Got it. Okay, all right. If you could tell us, there was, you've done some inorganic growth as well. Small hospital, I think, is what you had picked up. Tell us with the number of beds you have, how do you see this scale up? And is there more inorganic growth you're looking at?
Yeah, we have acquired the MG hospital in Vijayawada. That has been our inorganic growth. Right now, we are in the consolidation phase. So I really do not want to comment. And once, we get the consolidation done, I'm sure our management team with Dr. Manish Mathur will go and give more clarity on that in the future.
Okay, all right. Thanks a lot, sir, for joining in and giving us all of those details. Well, wishing you all the best, and we look forward to chatting up with you soon. Well, let's get in Vinay Rajani, the Senior Technical and Derivative Analyst at HDFC Securities, who joins us on the show. Hi, Vinay. Good to see you, Vin. Market's a little under pressure. How would you trade the index?
Yeah, good morning. Yes, definitely there is some pressure and profit booking is going on. So after 800 points rally from the lower level, Nifty gave respect to the 61.8% retracement of the entire fall, which we saw from 25,670 to recent low of 24,337 level. So 61.8% retracement is a golden ratio. So it has given respect to it, and after that it is into a profit booking phase. Now the support comes in at around 50 days EMA, which is placed around 24,850 odd level, and there has been also a swing low there. So there is a strong support around 24,850, around which Nifty could again find support and bounce back. So overall, we feel that Nifty is looking strong. On dips, one should accumulate longs, and support level is placed at 24,850. That is the level we are waiting for. Around that, we can initiate a fresh longs in the Nifty. Overall, we feel that the recent high of 25,150, 160 will be taken out, and we will be further head towards the major resistance of 25,700. So overall view is bullish, accumulate on the dips, and the support level is around 24,850. So this is our view, and so stock specific bullishness will continue to be there.
Okay, all right. What about, tell us about individual stocks?
Yeah, so basically I can see some strength building in defense space today. So Hindustan Aeronautics, HAL, which is hovering around its 200 days EM and trying to take support there. So I think HAL can bounce back from here. So HAL around 4511 can go long. I would suggest a stop loss at 4420. On the upside, I'm expecting a target of 4650 in next couple of sessions. The second pick I would take from the pharma space, that is Mankind Pharma. So there's a clear-cut breakout on the charts, and there has been a momentum in the sector. Healthcare pharma sector has been performing well for last 2-3 trading sessions. So Mankind is one stock which I like from this particular space. So around 26241 can go long. I would suggest a stop loss at 2575, and the target we should keep around 2700.
Okay, all right. We'll leave it on that note. Thank you very much for joining in with a quick perspective. So slightly sluggish morning for equities, at least so far. Let's put the spotlight on commodities now. We have Manisha joining in. Manisha, what's on your radar?
I'm looking at copper prices because we've seen constant declines onto this one. Remember, when you look at the month of August, from its highs, the copper prices have declined by almost 27% there. But we did see all-time highs as well, and this is before there was clarity on tariffs coming in from the U.S. market. So as of now, we understand that the refined copper is not tariffed. Well, the first thing on my radar clearly is what happened in U.S. yesterday, and Trump has criticized court decision that has temporarily blocked land transfer to big corporates, mining companies like Rio Tinto and BHP as well. In the last 24 hours, we've seen pictures and a lot of statements coming in from the CEOs of these two companies and the U.S. administration as well. Well, just to give you a background, Rio Tinto and BHP have been jointly pursuing the Arizona project for nearly a couple of decades now. So that is what the U.S. president seems to be pushing right now. And dispute has added to volatility in sense of prices, forward guidance, etc. So this is one thing to watch out for. And looking at this, we've seen some pressure come in for the copper prices. The second thing is about the U.S. administration really increasing or broadening the circle when it comes to tariffs. So that 50% tariff is now on imported manufacturing goods as well, containing many of these metals, so whether it's aluminum, copper, steel, etc. And that seems to be bothering the street as well, looking or assessing right now on how many products would it matter to and what really would the impact be to the U.S. consumer there. At this point in time, when you look at the U.S. imports itself, U.S. imported 810,000 tons of refined copper in 2024. This is all unprocessed refined copper. And these are the numbers for 2024. 25, of course, is going to be on the lower side because whatever imports that we have seen have happened anywhere between January to June. Then U.S. imported 45% of its domestic consumption of 1.8 million tons of refined copper. So that's a big number and is expected to impact the markets there. The third important thing, of course, is the strengthening of the US dollar index. It's trading 0.5% higher in the overnight markets. And this is ahead of the Jerome Powell speech at Jackson Hole. There's lots that the markets are getting into with that speech on what could really come in. Was it going to be a power-packed one, or is it going to be a non-committal statement from Jerome Powell? So that really seems to be finding its way in markets. As of now, the agenda clearly is that Powell will speak on economic outlook and the Fed's policy stance going forward from here. Fed has kept its rates unchanged since the month of December, but there is now a 70% possibility of a 25 basis point rate cut for the month of September, and that's exactly what seems to be getting baked into the prices. But all eyes on Jackson Hole at this point.
All right, Manisha, thank you very much for that. So that's commodities in focus. We're going to slip into a quick commercial break here. More on markets, but specific stocks which are moving around. Stay tuned. Coming up.
Welcome back. So quick check. Like we've been saying, it's a bit of a sluggish day, 100 points down on the Nifty. But the good thing is that it's not like it's a non-stop one-way decline. There is some sense of buying at lower levels as well. And the mid-cap index is now flashing green. On the large cap screen, I just want to point out Hero MotoCorp. That's the weakest stock on the Nifty right now. The cut-off almost 2%. That's something that really stands out. And then, of course, there is R Systems. And we've been talking about that stock. Right from our top 10 segment, the company has gone ahead and made an acquisition, and the market seems to be giving it a complete thumbs up on the back of that. There's Apollo Hospitals also, which is in focus on the back of that large trade that happened. In fact, let's focus on Apollo right now because we have confirmation now. It is promoters who've sold off a little bit of their equity. Vinny, tell us more.
Yes, so we have seen that, in the morning trade, we saw Apollo fall and now that has recovered. Why? So we knew Sunita Reddy was selling stake in the company. They informed exchanges that Sunita Reddy has sold around 18.97 lakh shares. That is amounting to around 1.3% stake. This is at a price of 7,850 rupees, 1% discount to yesterday's closing price. But the important thing is that why the stake sale is coming in to reduce the pledge in terms of the holdings that's there, right? So after the stake sale that comes in from Sunita Reddy, now the pledge holding of the promoters post this transaction will reduce from 13.1% to 2%. And that is why that recovery that we saw coming in the stock from the today's lowest point. So keep an eye out on Apollo Hospitals. This stake sale is not for any personal reasons. The promoter is not selling stake for personal reasons, but for reducing the pledge. That is the main reason.
Okay, all right. Thanks very much for that, Vinny. So keep an eye out on that one. PTC Industries is the other one, which sort of opened sharply higher. Ria is here with details. Ria, morning.
Well, good morning. PTC Industries is up around 7 to 8% today after bagging an order worth about rupees 110 crores from BrahMos Aerosystems for the supply of critical titanium castings. And the execution period for this is about 24 months. Now, just looking at PTC Industries in terms of the performance in Q1, the revenue had more than doubled to rupees 97 crores, but we've seen a very sharp fall when it came to the operating profitability. EBITDA margins had contracted by around 1,237 basis points, coming in at just about 9% in this quarter. And this profitability was largely impacted by significantly higher employee expenses, which were at 35% of sales versus just about 17% of sales in Q1 of last year. Now, coming to the outlook for the company, they do aim to achieve a top line of about rupees 750 crores in FY26 and 1,700 crores in FY27 versus just about 308 crores that they saw in the last fiscal. They also said that they are comfortably placed on the order book and they're expecting margins to be in the mid to higher 20s in FY26. In the longer term for FY29 to 30, they are looking at about 2,500 to 3,000 crore in terms of the top line with a 30% margin. So the outlook remains strong for the company, and on the back of this order win today, it's up around 7-8%.
All right. Thank you very much for that, Ria, with details there. PTC doing well. We'll take a quick commercial break. Another one special segment. It's the economy. Lata in conversation with S. Ganpati of Gokuldas Exports. It's a management you must hear from in terms of the tariff impact, etc. The 25% additional duties go into effect coming Wednesday. If they do. Sudhir Sekri of Apparel Export Promotional Council, of course, also a very important voice there. Lata in conversation with both of them on the textile space in just a bit.
Welcome to It's the Economy. As we draw close to August 27th, when the 50% penal tariff may take effect, government is trying to plan a package for the affected industries like textiles, leather, jewellery and shrimps. Government has already scrapped the 11% duty on raw cotton imports till September 30th. What more does the industry need? Should government simply transfer that 25% penal tariff amount to the impacted parties, or will it suffice if they just arrange easier working capital loans? Generally, make doing business easier for everyone. For all these questions, I'm joined by Mr. Sudhir Sekhri, Chairman of the Apparel Exporters Council, and Mr. Shivaramakrishnan Ganpati, the CEO of Gokaldas Exports. Gentlemen, good morning and thank you very much indeed for your time. Mr. Sekhri, you all must be already in conversation with the government. I guess there is some scenario planning. If it is 50, what have you asked?
Well, you see, if it's 50, if we are talking about the entire export trade, $47 billion is the value that is affected, the export that is affected by this oil tariff. And 25% of that works out to about $11.75 billion. So we have a potential out of pocket of about $11.75 billion. If you come to specifically to apparel, our export is $5.2 billion. So our potential out of pocket is about $675 million. Now, to answer the question, what we asked for the government, obviously, we asked government to help us with this, with some kind of a direct subsidy in the form of, say, market focus scheme or MAI or so this is in the form of, we're not asking them to shell out this money in one shot. We're asking them to give us scripts, which would offset the scripts to the extent of this amount. We exporters can use for paying of duties on the import of various items.
Okay. But is not the duty anyway set off when you export?
No, see, we are talking about import. I'm saying this duty, this script will be towards the import of, if you do
raw material.
And these are also transferable. So I don't have to use, it's not an actual.
All right, got it. You can use it for anything else.
And they can sell at a premium.
You can have a market for it. I get you, sorry. Mr. Shivaramakrishnan, what's, as a person who is at the wheel, what is a more sensible way, less hurtful way? Do you need a 1 year of hand-holding, and how?
Obviously, we have to wait and see if the additional 25% kicks in or not, right? And all of this is subject or caveated on that.
Yes.
So if it does indeed happen, then obviously the industry needs some support. There is no question about it. With, as Mr. Sekhri said, there's $5.3 billion of exports going on to United States, and that is growing. So, the exports to US has been growing at a much faster clip than exports in general. So it's been a preferred market. It's a huge market for us, and a market which, in the next 5 to 10 years could have been much bigger for us. So we can't afford to lose the business. What happens if there is a high tariff like 50%? Is that brands will take that business away to other countries over a period of time, right? Overnight, they cannot find capacity for $5.3 billion. But, over a period of time, say a year and a half or something like that, they will find alternative capacities. So we have to hold fort until then, and also try to see if we can pivot to other countries, diversify a little bit more. And that is where the support is required. If support can come in any form, right? And I'm saying support which particularly addresses this high tariff would be really helpful. And as far as the other supports are concerned, which you mentioned upfront, right, where the ease of doing business, procedural aspects, etc., I think that is required anyway for the growth of the industry. And if now we get give that an impetus, it will certainly help from industry to tackle this problem.
Yeah. We always reform under crisis. We did that in 91. And an action replay is perhaps called for, remove procedural bottlenecks. Before I come to the nitty-gritties of the procedural bottlenecks, Mr. Sekhri, what is your conversation with the government? I'm not surprised they have not announced anything because everybody wants to wait till August 27th. If there is a change of heart or change of strategy on the part of the United States, one doesn't have to hurry and announce it even on August 26th. It can be announced on August 28th. But what would be your ask if on August 27 we are exactly at 50?
Well, see, first of all,
you said scripts. What else would you ask?
Yeah, there are many others. We've made quite a few asks of the government, and this is the major ask that I just mentioned. Okay. And I also, like Mr. Seva just mentioned, we also believe that, and the government also, that this 25% oil tariff is not really sustainable. And we wish that this goes away earlier than later, because this is the tariff which is really going to break our backs, so to say. Because the earlier 25%, we had kind of negotiated with our buyers and we had come to some kind of a settlement. But now coming back to what our other asks are, of course, we are asked for, there's this 2,250 crore rupees lying in the export promotion mission, which was sanctioned in the budget. That has still not been disbursed. There is some surpluses lying with the Ministry of Commerce, which again, we are asking them to please, at least whatever has been sanctioned in the budget, kindly release that to the exporters. I mean, that's a very small amount though.
Yeah, exactly.
Yeah, it's not even, if you're talking potential loss of $11.7 billion, this is not even $250 million.
No, for exporters, I think your loss, you are talking about $1 billion because you said it's around 5. So around 25% would be a little more than $1 billion. So 2,000 doesn't go a very long way. But, what about timing? Mr. Sivaramakrishnan, let us assume that the government is mentally agreed to reimburse this 25% penal tariff in some form. Would it be okay if they paid it only afterwards? It would be okay for an organized corporate like yours. But for a large percentage of, say, leather exporters or Tirupur small exporters, they would want some advance help, isn't it? Any thoughts on that, Mr. Sivaramakrishnan?
So obviously, during COVID, there was a working capital, scheme that was announced for particularly MSMEs took a big advantage of that. So some of those kind of, arrangements for corporates. This is a working capital intensive business, and right, almost 25% of your revenue sits in working capital. Okay. And many companies, if they lose their orders, they will be working capital strapped. They will have banks panicking and all of that, especially the smaller ones. So some sort of a working capital interest moratorium or payment moratorium, some degree of support and preferential interest rates. A scheme like that could definitely help, particularly the MSMEs who will be hurt harder if they have a high US exposure. Okay. So the schemes like that can certainly help. It will be financially supportive.
Okay, Mr. Sekhri, similar question to you. Can the money come post? You show your export bill and 25% is reimbursed by the government. Does that work? For the government, that will work better because they're very sure they're giving it to the party that has exported. But should it be paid in advance for some parties at least?
Yes, of course. We would wish that to happen because you see, our point is that, by this oil, what we call this oil tariff, we are saving about, in the import of oil from Russia, we are saving about $12 billion, in terms of duty and the rate differential between US and the Russian oil. And we are losing at about 11.75 billion. I'm talking about the
in exports. So it kind of cancels.
Yeah, we've also asked for immediate revival of the interest equalization scheme, and which expired in March 2024. Okay. So we've asked them to revive the scheme temporarily. Okay. And there are, of course, other schemes also. Like I said, we've presented a paper to the government, the Ministry of Commerce, where we've listed out the assistance that we need from the center.
Okay, 1 minute, Mr. Sekhri, instead of asking what you want, because we always want the moon, what has the government so far indicated to you?
See, the government has indicated that, first of all, what they have already agreed to is the extension of the RSCTL and ROTTEP for another 5 years.
But that's peanuts.
I know. But then, that is what we are saying. We're looking at a huge amount, and the government is not really in a position I mean, this is what we've been. I met the Minister of Commerce, the Minister of Textiles. I met the Principal Secretary and the PMO. I mean, all of them say that, you know, the direct subsidy that we are asking for, the government is not in a position to pay that. So what else do? I mean, then we'll have to ask them for, you know, smaller things, but put together can become a big amount.
I don't know whether 1 lakh crore is such a large amount for India at this point in time. I mean, we are a 400 lakh crore GDP. It doesn't look, and it is not anyway for the long haul. It is only for this season. Mr. Ganapathy, what is your sense? Will you be able to find alternative buyers after FY26? Does it? Is the crutch needed only for the year?
I think, if a crutch is available for a year, it'll be great. Any pivoting takes time. The sales cycle, onboarding of a new customer cycle is year and a half long. So it's going to happen. Of course, everybody will try to do it as soon as possible. And, people have already started. All of us have started. But minimum a year, but I would say it's a year and a half it'll take by the time you pivot. But, any support for a year would be great if there is something available. That's more than enough time for Indian exporters also to find solutions within themselves.
Okay. Mr. Sekhri, similar question to you. Will a year be enough if they handled the textile industry for this year, FY26? Will that suffice? And what are you seeing as alternatives that the industry might do? Will they look for alternative markets in the EU or Far East or Japan or wherever? Or will they relocate their own industry from here to Bangladesh to Vietnam or whatever? What are you likely to do?
Yeah, okay. So to answer your first question, how long do we want the government to handhold? Well, as long as this 25% tariff is there, we like that. Because there's no way that the industry can bear the oil tariff for 25%. No way.
No, but the government will say don't export to them. No, this year is too much. You cannot find a new buyer in a month. But surely in a year or so, they will expect you to find. You can't expect them to give you the help as long as 50% exists.
Yeah, so now that's what. See, first I said the hand-holding we want as long as the tariff is there. And we don't believe the tariff is going to stay for long.
Okay.
But anyway, the other thing is, of course, we are already, for the short term, we've already speaking to our buyers across the table, negotiating terms with them, negotiating a discount with them. And quite honestly, with some of the buyers, we already arrived at some kind of an arrangement. Okay. And of course, we are going to be out of pocket. But we hope that this does not prolong beyond a month or 3 months or beyond this financial year.
Okay.
And we know that with this 25% will be none of the exporters, garment exporters at least, will be able to show a profit. We'll all be in the red.
Okay. No, I agree that maybe this 50% is for a few weeks or a few months or not at all, God willing. But assuming it is there, are you all likely to relocate or are you all likely to find new buyers?
That really depends on what your exposure to the US market. If like Shiva's exposure is probably 80%, then he has to explore other markets, which is no other option. But if a person's exposure is just 20-25%, then exploring other markets for production does not make sense.
No, it's not.
Definitely for marketing, for selling, we'll have to explore other markets.
Okay, fair enough. So it'll depend on industry and it'll depend on the company. I take your point. Let's hope, of course, things change before August 27th and we don't have to. And all these are hypothetical discussions. Thank you very much, Mr. Sivaramakrishnan and Mr. Sekhri for joining in. We will touch base after 27th. Wrap up on Bazaar. Chart Pulse is coming up.